And nobody saw that 0.5% on the overall CPI.
Is just how far off the mark the analysts were on this.
It absolutely does, and that's a big deal for traders. The market was pricing in.
And you can either be blindsided or you can learn to see what's happening beneath the surface.
And this report just made it a whole lot harder.
JP Morgan is predicting that the S&P 500 could drop by.
A hotter than expected CPI should have sent stocks down, but the market barely flinched, and many traders have now brushed it off and forgotten about it. But smart money hasn't. See, there's a big difference between ignoring and waiting. And if you don't know what they're waiting for, the market might just pull the rug out from under you. In this video, we'll break down what's happening beneath the surface and why it matters more than you think. It's not about being scared, but being prepared. So, to paint the full picture, let's first understand what the market was expecting before the CPI was released, before the numbers dropped.
There's some headwinds, right?
Yeah.
We've got, tariffs, we've got like AI uncertainty, and I think the big question on everyone's mind right now is inflation.
Yeah, absolutely. And with the January CPI data coming out, there's a lot of people wondering what's going to happen.
So that's exactly what we're going to deep dive into today. We're going to try to figure out, what are the experts predicting and how might the market react? And you sent me over some analysis from JP Morgan Chase & Co., so I figured we could start there.
Sounds great.
JP Morgan is predicting that the S&P 500 could drop by 2%.
Wow.
If January's consumer price index rises by, 0.4% or more.
Right.
And I mean, for someone who's, trading the market, that's a pretty significant drop.
Oh, absolutely. The thing is, investors are already kind of on edge, right? So, a bad inflation report could really spook them. And
Yeah.
we could see a sell-off, which, that would derail the rally.
Right. So, what is JP Morgan predicting as the most likely scenario? I mean, obviously they said, worst case it could drop 2%, but
Yeah, so their base case, their most likely scenario is actually a CPI increase between 0.27 and 0.33%. So,
okay.
Not as drastic, but still something to keep an eye on. And then you've got the consensus estimate, which is just a 0.3% rise.
Okay.
And then you look at the options market, and it's kind of implying a move just below 1% for the S&P 500.
So it seems like there's a range of possibilities here,
Yeah, definitely.
but everyone seems to be kind of aware that there's a potential for a pretty decent sized drop.
Yeah, for sure. The options market is not in a full-blown panic, but they're definitely pricing in some volatility.
Let's recap to make sure we're all on the same page. The consensus estimate for month-on-month inflation was 0.3%. That was the expectation. But if CPI were to hit 0.4% or higher, JP Morgan Market Intelligence expected the S&P 500 to drop between 1.5% and 2% that day. And they weren't alone. Goldman Sachs anticipated at least a 1% decline if inflation topped 0.4%. In other words, anything above 0.4% was a clear bearish signal. So, how did the S&P 500 closed? She barely flinched, down just 0.27%. Surely that must mean CPI came in well below 0.4%, right? Well, not quite. The consumer price index surprised everyone, landing at a staggering 0.5%. Let me say that again, 0.5%. The consensus expected 0.3%. JP Morgan warned that 0.4% would trigger a sell-off, yet the market faced an even hotter number and still shrugged it off. In fact, just 4 days later, the S&P 500 rallied 2% to hit a new all-time high. But that calm didn't last long, because a big bearish candle was brewing beneath the surface. And if Friday's drop caught you off guard, then it's time for you to get more familiar with the insights we share here on Bourseologia. Why? Because situations like these will keep happening, and you can either be blindsided or you can learn to see what's happening beneath the surface. If you're new here, I recommend checking out our previous CPI analysis or our last video, where we specifically flagged the importance of Friday, February 21st. We've linked both videos in the cards. Of course, you can also stick around as we break down the latest CPI report, because as long as inflation remains an issue, we'll be here every month dissecting the numbers and what they mean for the markets. If you're interested, activate the subscribe button to unlock arcane insights and empower your trading journey. Now let's dig into that report.
Right, so let's just jump right into it. The report, and, well, it came in pretty hot.
Yeah,
Hotter than I think most people were expecting.
much hotter.
Yeah.
This is one of those reports that can really shift the market.
Exactly. So let's not waste any more time. Let's dive right into the headline numbers. The CPI jumped 0.5% month over month.
Wow.
Way past that 0.3% forecast that, everybody was kind of expecting.
Right.
Year over year, it's at 3%. Now, core CPI, which of course strips out those volatile food and energy prices, also surprised us.
Yeah, that was up 0.4% month over month and 3.3% year over year.
So those are the numbers. But what's really striking, and I want to get your take on this, is just how far off the mark the analysts were on this.
Yeah, I mean, it's pretty amazing. Bloomberg surveyed like 73 economists, and only 5 of them even came close to predicting that 0.4% jump on core CPI. And nobody saw that 0.5% on the overall CPI.
Yeah, so what do you think? What are the implications here? Because this really throws off that rate cut narrative, right? The one the market has been kind of betting on.
It absolutely does, and that's a big deal for traders. The market was pricing in cuts, maybe even multiple cuts this year. And now, I mean, we're not even sure if cuts are on the table at all. Some people are even, and I'm not saying this is going to happen, but some are even talking about the possibility of a hike.
A hike? Wow.
Yeah, it's unlikely, but even the fact that it's being considered, it just shows how much this report has shifted the conversation.
Right, that's a major shift in sentiment. So let's talk about how the market reacted to this news, because it was pretty immediate, right?
Oh yeah, futures tanked almost as soon as the numbers came out. The 2-year Treasury yield, that spiked up 9 basis points, hit 4.37%, and the 10-year yield, that went up 7 basis points, landed at 4.60%. The dollar surged. And you look at the swaps market, that's where traders bet on future interest rates. Well, that's signaling that a September rate cut is basically, it's off the table.
Really? Gone.
Yeah, they're now only pricing in just one 25 basis point cut by December. So that basically pushes the expected cut from September all the way to December.
Wow, that is a seriously bearish signal.
It really is.
So let's dig into what's actually driving this inflation spike. Break it down a little bit.
Sure. Shelter costs, especially rent, were a big factor. That was up 0.4%. And then you've got energy prices. Those jumped too, with gasoline up 1.8% and fuel oil surging a massive 6.2%. Used cars and trucks climbed 2.2%.
Okay, so, we've been hearing this narrative that inflation is supposed to be, transitory. Is that even a word anymore?
What's really worrying is the stickiness, I guess you could call it, we're seeing in some of these categories. Like, look at prices for things like motor vehicle insurance. That's up 2%.
Really?
Airfares, education, these aren't things that are just going to go away anytime soon.
They're just stubbornly high.
It's a problem.
Yeah. So if we zoom out a bit, what does this mean for the Fed? What are their next moves? What are they going to do?
It puts them in a really tough spot. Lowering rates, which is what a lot of people thought they were going to do, that could actually make inflation worse.
Right, kind of pour fuel on the fire.
Exactly. And, we've got to remember the White House. They want lower rates to help boost the economy.
Yeah, they've made that pretty clear.
Oh, yeah. And JP Morgan's chief global strategist, he even came out and said there's nothing in this report that justifies a rate cut.
Wow. So, where does that leave the Fed? What are their options here?
They're walking this really fine line, this tightrope, trying to control inflation while also making sure the economy keeps growing. It's a tough job, and this report just made it a whole lot harder.
Yeah. Okay, so this is a lot to process, I know.
It really is.
Before we get into what this means for, you guys, the traders, what should we be looking at in this report? What are the nuances we should be paying attention to?
Okay, there's this metric that's really important. It's called Supercore services. It strips out housing from the core services number. And this jumped a massive 0.76% in January.
Okay, so what, like the biggest jump in a year or something?
Yeah, the highest in a year. And what this suggests is that those strong wage increases, the ones we saw in that jobs report recently,
Oh, right, yeah.
those are actually feeding directly into service prices. Wages go up, businesses got to raise prices to keep up, and boom, you've got this cycle going. Now, some people are saying that, seasonality might have played a role in this Supercore jump.
Okay, so some things just cost more at certain times of the year.
Exactly. But even if that's true, the Fed can't ignore the fact that inflation is accelerating, that it's moving away from their target. They want to see inflation slowing down. But this report shows the exact opposite.
So it sounds like they're stuck between a rock and a hard place.
Yeah, pretty much. And we have to remember, we haven't even seen the full impact of those China tariffs yet.
Oh, right, the tariffs.
That's a whole other layer of complexity that could come into play.
Yeah, things could get even more complicated.
Now, let's establish the facts. After peaking on December 6th, the S&P 500 dropped 5.36%. But on January 15th, when the Consumer Price Index for December was released, the market didn't just stabilize, she rallied. That previous CPI report dropped at exactly 8:30 a.m. And if you look at the chart, the reaction is undeniable. This isn't speculation. The CPI was the spark. We broke down that report in a previous video and explained precisely why the market surged. Now, fast forward to February 12th, when this latest CPI report hit. Except this time, the numbers were bad. Now, let's be clear. The previous CPI wasn't exactly good. It was just better than feared, and that was enough to ignite a rally. But here's the thing. If the market surged on better than feared data, wouldn't it make sense for the market to drop when those fears are confirmed? Logically, if the positive catalyst from December's CPI was erased, the market should adjust downward, right? That's why we opened a short position before the report dropped, and when the market plunged, we made money. Granted, we could have made even more if we'd covered at the open, because the market bounced back fast, and as we mentioned earlier, just 4 trading days later, it was as if that terrible CPI report never even happened. Clearly, bullish sentiment is still in control. Dip buyers have been rewarded time and time again, and despite the bearish initial reaction, the market treated the drop as just another buy the dip opportunity and pushed even higher. However, and this is the key point, once the dip is no longer a dip, those CPI concerns were bound to resurface. After all, if the market has reached a new all-time high, that's obviously not a dip. It's uncharted territory. And in that environment, the bullish dip buying evaporates, while inflation concerns remain firmly in play. Just like I said earlier, there's a big difference between ignoring and waiting. Smart money didn't ignore the CPI data, they just waited. And speaking of what smart money is watching, in our next video, we'll break down the upcoming NVIDIA earnings, digging into the research and uncovering what you need to know. So, if you haven't already, consider liking this video and activating the subscribe button to unlock those arcane insights.
Stay tuned, everyone, because things are about to get very interesting.